Hey everyone, hopefully you're having a good day. My name's Andy. My channel's Finding Value. We're gonna rip through Twitter, see what's going on in the Twitter space surrounding news and all this stuff. It's gonna be financial related, wealth related, financial, commodities, whatever it is. I usually focus on commodities, not because I am a perma bull in commodities. I am a bull where I need to be a bull. And the commodity to stock ratio and the technical analysis of all these long-term charts look fantastic for commodities. So that is where I'm focusing my efforts, is where I think I'm going to get the largest returns for those efforts. The market is guiding where I should be looking. It's not the other way around. I don't think commodities are going to do well just because I made it up in my head. I think commodities are going to do well because the evidence suggests that they are going to do well. So I just wanted to kind of go through that real quick. I did post a lot of charts myself this time, so you can see kind of what my thoughts are on the big picture view of what's happening. And we'll dive in and we'll get a bunch of other people's opinions as well as we go through all this different information out here. Again, if you need help with anything, you can check out you can check out at @finding_finance on Twitter if you want to join, or you can check out my website, finding-value.com, and you can see the individual companies that I'm playing this with. I've got a lot of individual companies. I think that I've chosen the best, highest torqued companies to what's coming. I also have a lot of dividend-paying companies that I am also focusing on to create a dividend portfolio for this commodity bull market. I'm playing it both ways. So let's dive in. Let's see what's going on. So I've got commodities to stock market ratio. Patience, calm, relax. It's coming. So again, stocks outperformed during this period and money went into stocks and not into commodities. We have a bottom here in 2020. That is where I loaded up, was this bottom portion in here in 2020. And we came up, we've broken that downtrend line, and now we got our first big pullback in commodities versus stocks. This is the cycle, guys. That's what happens. So we have a new paradigm where commodities will outperform after this break. We're coming on back. Stocks are going to put in my opinion, a bull trap, and commodities are going to put in a bear trap. And again, the bear trap is where we pull back and people are going to become in disbelief of the commodity market. On my YouTube channel, go check out the comments. People are in disbelief and they're going to go run over to the tech sector, just like little hockey players do when they go chase the puck. They chase the puck when they're young, and you get this big group of players all around the puck, wherever the puck moves. That's just like new investors chasing wherever the price goes up. They chase wherever the price goes up and say, oh, the price is going up. I'm going to go chase it over here. And that's what they do when you're a new investor. If you're a seasoned investor, what you chase is value. You chase the market conditions that are ripe for the valuations to change, and you go after what's cheap and where those conditions are going to change. So in my opinion, that is where commodities come into play. Commodities are underpriced, and I think that the market conditions for those valuations to change are right here, right now. And they're going to last for a decade, but we're not going to go straight higher for the entire decade. We're gonna move in waves. They're going to come up, pull back, come up, pull back. And some of these sectors are really hard to hang on to. They are very volatile. They go up, they go down. We could see pullbacks of 40, 50, 60% in a bull market. That does not mean that we are in a bear market. So these big pullbacks, they're going to fake a lot of people out. And what it's going to do is it's going to tear your money away from you because you haven't done enough analysis. You haven't done enough homework to kind of get yourself situated and oriented on these big cycles. So there's that. Commodities should outperform over the next 4, 5, 6, 7, 8 years. We've got Logan here. This is a driver of this. So this is a driver of this. What happens is, it says, when rates fall, it has never created more active listings one time post 2010. Not once. It creates more demand, but it has never created more inventory If I had 1 year of data to show this to be the case, I would say there is a shot. So here's the thing. Declining interest rates are going to push more credit expansion in the system from the housing market. The credit expansion is causing this rotation of commodities, of money into commodities and away from the SPX because it's going to push interest rates higher again. So if they were to lower interest rates, it's going to increase demand for homes, especially new homes, because we're at such low inventory levels of existing homes that it's going to push demand towards new homes, and those new homes with new loans is inflationary, and that inflation creates higher interest rates, which is going to cause a rotation into commodities over the SPX, and that's what happened in 2020. And then when the interest rates kicked up, commodities outperformed. We are in a slowdown period called wave 2. Wave 1's the initial wave, wave 2's the pullback, and then we get a big wave 3, which is the largest wave of all of them. We'll get a wave 4 pullback, which is not as big as wave 2, and then we're going to get another last 5th wave move to the upside, which is a ways away. This is driving it right here. And if you guys don't believe me, go check out my other videos. Go binge watch my other videos if you don't think I'm right, because go check out my thesis videos and my thesis update videos. Go look at them, get it, watch them, and come up with your own thesis. Put it in the comment section what you think your own thesis is, if you've got one. I think this is what's driving it because I've looked at history. The 1970s was a demographic that came to home buying years, credit expansion phase, peak spending years. All of that contributed to a commodity bull market because it puts everything into a shortage of GDP. You have money coming into the system faster than goods and services can be created for that demand of the demographic coming through. That's what it is, in my opinion. Here's Grady, and I think he's got his head screwed on straight. He takes the big picture view just like I do. Very similar. It says, retail is nowhere to be seen yet in this commodities bull market. Don't listen to the naysayers, especially not in the markets. The majority has to be wrong, not only in the markets, really. So pat yourself on the back instead of questioning yourself. You are very early. We are early, guys. Completely agree. We're just coming into an expansionary phase. We just broke out of this commodity to stock ratio, and all of the charts in commodities look like they are putting in some really ridiculous patterns. And we're going to look at those patterns, and I'll show you what I'm talking about. Coming on down. So here are some of the patterns, all right? Housing starts compared to platinum. Things heat up above the white average line in an expansion phase of real estate. So these expansion phases of real estate, you can see this came up into an expansion phase, and we just lit it up for platinum. We came down and broke below the average, and this is where we're out of favor now. We're out of favor, out of favor, out of favor. This is all out of favor, and we consolidated. We broke back above the average line here, and we could see platinum starting to get excited. And I think that we are going to see a big move in housing starts over the next 5 years. And when I mean big move, it's going to stay elevated. It's going to allow platinum to move higher, I think. Platinum is an inflation-sensitive asset, much like oil is. And I think those two assets could do the best when inflation reignites. And I know that we're slowed down some. Yep, they raised interest rates. Not they, but the market really forced them to raise interest rates. The market forced everything to raise rates, and things have slowed down. I agree. If rates were to come back down, or if we were to see the housing starts move on up, even with rates that are elevated, I think we're going to see more inflation. Credit expansion phase. Here's some more charts. Gold to oil ratio on top compared to 30-year to 10-year yield. I also put gold compared to the TYX-TNX ratio. So this is the gold to oil ratio. It's at 27.72. It's a pretty cheap ratio. But one thing that we can notice is that when this ratio down here, the TYX-TNX, when it goes up, we usually have an increase in the gold to oil ratio. It remains elevated. When this goes back down, we see it come back down. We see a massive move up to the upside, massive move up to the upside. So what that is telling us, this is a gauge of fear in the market to some extent. So when this goes up, it's a fear move. And when you go up, people run into bonds. And what it does is the curve uninverts. When it uninverts, we can see that oil is not a benefactor of that. So these are all tied together. It's giving us a viewpoint of the market conditions. The market conditions are what are pricing these assets. And what we've got right now is we're calming down on the gold to oil ratio. We're still at a very cheap ratio of 27.72. That is very inexpensive for oil. But we could come back up some, and we could see a big bull market, much like we did in the 2000s. This ratio could go up, but it could go up very slowly, and oil could do incredible things during that time frame, depending on the cycle. So I think that we are aligned quite well, like we were in the 2000s here, like 2004, 5, 6, 7, 8, somewhere in that range, all in through here. I think we're in that same type of bull shape area that we're going to enter into. We could also still be earlier than what I think, because we haven't built the homes to satisfy the housing imbalance. The expansion phase is still in front of us, at least in my opinion. And I know some people disagree with me, but good luck with that disagreement. You've got no inventory and a lot of people who want to buy homes. So here's the stock market again. Brazil ETF looking, well, it's looking awesome. Again, this is your phase here, which is your recovery phase of real estate. It started in 2008 and was in a recovery all through here, and now we're going to an expansion phase. This is going to blow to the upside. Expansionary phases are inflationary. Typically, the DXY drops at a certain point. I think we're at that point where the DXY could drop, where monetary conditions are tightening in other currencies at faster paces than the tightening or pausing of the United States. That generally drives the DXY lower, and it drives all of these emerging markets higher. So the TSX, the EWZ, which is Brazil, TSX is Canada, and emerging markets like China, India, those types of countries, we could see an outperformance in. Homebuilders. It says Homebuilders look solid. Some people say we are in a housing market bubble. Looks to me that the homebuilders are just getting started. So I'm taking a disagreement. I'm disagreeing with those housing bubble people. I know I'm in the minority, but the minority is going to beat the majority. The majority almost always loses. Leonard Corp breaking to the upside here, making new all-time highs. We've got Meritage Homes Corporation putting in a gigantic pattern, ready to break to the upside. I'm giving these away, guys. These are very solid picks. You can watch. If we get a breakout here, you're probably going to see a run in MTH. LGI Homes breaking to the upside here. Still doing the Livermore accumulation cylinder that we're probably going to just rip it to the upside. And then we've got KB Homes. Notice the similar trait in 87 to 90, early 2000s, and then the rip higher. We've got the same recovery phase ripping back and forth here, much like a Livermore cylinder or something like that. Now we're ripping to the upside. This thing could rip all the way up for the winner's curse phase, which is the big move in the real estate market. And I know that seems weird, but that's where we're at. And I know Powell, he's raising rates, trying to stop this move from coming. This is where the inflation is being driven. He's trying to raise rates fast enough to stop this move. Problem is, you can't stop that move. It's a demographic coming through home buying years that wants to buy a bunch of homes, and the homes do not exist. Now, I know a lot of people will say, oh, well, homes per capita, guys, jam that statistic up the bunghole there. It's got to be sold. You got to sell the house. It's got to be for sale. If somebody owns 3 homes and they're not for sale, what difference does it make? It makes no difference. So home builders, they're going to be active. It's going to roll on up. Could the deaths offset from the baby boomers some of it? Yes, it could offset some of it, but not all of it. At least that's my opinion. Right now, the momentum's to the upside. We'll see where this thing goes for the home builders. The home builders look very strong, very strong. Some of the strongest charts are in the home builders right now. Now, is it possible to have strong charts in the home builders from a level this big, from 2000, mid 2000s, all the way of a breakout or retest, and now into all-time highs, which is a brand new big old uptrend that we've got? I don't think it's possible that this is wrong. I don't think it's possible. Now, people, if we get a short-term pullback, they're going to say, oh, you're wrong. They just don't know how the heck to look at anything. That's my opinion. You have to look at it from a big long-term perspective. You got to break key levels to the downside, and you have to have a bunch of inventory. Right now, we have no inventory. Home builders are breaking out. Home prices are going back up. That's what the data is suggesting, or what the facts are. And the data is suggesting that that's going to continue to the upside. Put it that way. What I have here is ready, set, launch. So this is actually more data, more bullish evidence for a housing market expansionary phase and for a commodity bull cycle, because they're interconnected. This is all interconnected. The expansionary phase is the market conditions that it occurs under, and these are the things that move in relationship to that expansionary phase. So when we look at this, platinum moving higher to the housing starts is interconnected to gold and the oil ratio, which is interconnected to the TYX-TNX ratio moving up and down, which is interconnected with the emerging markets being repriced from lower dollar to an increasing interest rate environment. And this phase where we hold rates, what happens is we hold rates in America, perhaps, or we move rates higher at a slower pace than what other countries' currencies are doing. So they're going to be tighter, we're going to be looser, and that's going to drive the DXY down, pushing all of this stuff higher. So REMX, ready to break to the upside, guys. This is in launch mode, and this is the ideal entry point for a potential entry point for a technical chart analysis. Like, you get a double bottom, bottom one, bottom two, that's your booty bottom. Then you get a pullback to the breakout, and we're basically setting this up for a big move to the upside. That is also happening in lithium. It's also happening in tan, the double booty bottom, the breakout, the retest, and now we're preparing for a potential launch in the future. And then we have Uranium that's also breaking out. And again, we could get a return move here. Don't get worried about it. You're just going to have to say, you know what, we might get a little bit of a pullback. We might get a return move to retest the breakout. And then it's, a move to the upside. And it doesn't mean that we move straight higher. We've got resistance levels through here that we're going to have to break. We may come up and pause and move up in these waves. We may trampoline jump, is what I'll call it, to the upside. We've got uranium here, the Sprott Physical Uranium Trust. Again, this is more evidence that we have an expansionary phase of real estate, that the home builders breaking to the upside is not a fluke. Because if it was a fluke, we would see these forming tops and dropping. They're not dropping. These are putting in bottoms that are about to start new uptrends for REMX, lithium, uranium, solar. We've got all the home builders agreeing with it. We've got emerging markets. Guys, there's no way this alignment could have happened without this all being interconnected. So here's the Sprott Physical Uranium Trust. This thing looks fantastic to move higher. I think it's ready. We could go ready for launch mode. That's what I'm saying. We could get a launch here. Now, I'm not saying that it's going to be immediate. We got to break out. We might do a retest. We might not. And then we rip. So maybe we've got another month or two. Maybe we don't. I know a lot of people, they try timing the short term. Timing, it's opportunity cost. Guys, shut up with the opportunity cost stuff. Really, throw that in the garbage. Because when this moves, the move will be so violent and so big, it just doesn't matter. If it takes 6 months, it's not an opportunity loss. You're in the opportunity. And if it takes that amount to develop, which a lot of these things do, they take time to develop. And if you get a 10-bagger in an equity, that's not lost opportunity. That is capitalizing on opportunities. So I know I hear some people, oh, I'm down. I bought at this like peak right here. It's like, calm down. Sometimes that happens. Let it take you higher. Let this gigantic tsunami be your tailwind that's going to push us and push us in that direction. If you're fighting against the tsunami, you're going to go run at the tsunami. Go for it, guys. You're just going to get completely destroyed trying to run against that tsunami. Get it as a wave that's going to be behind you, and let that thing push you forward. That's what's pushing us forward. The expansionary phase of real estate, and all of these charts look fantastic. Natural gas. So natural gas, TTF gas coming alive again. We had a once in a 40-year event in weather over in Europe that draw this back down. This is, again, we have not fixed anything. This thing could launch for whatever reason. So we're getting a nice little move higher here in the short term. I'm not saying we're going to launch. I'm playing this from a long-term perspective. And I think oil and natural gas are inflation sensitive, which is great if you're in an inflationary environment. I also think that if the inflation's in the system, it's going to put everything into a shortage. And oil is the number one commodity, the most inflation sensitive. But nat gas is looking good. Here's oil prices. So oil sitting on top of its long-term trend line. Circles are the bottom of the commodities to stock ratios. Both bull markets occurred under expansion phase of real estate, which is credit growth. And here we are. This is a logarithmic chart of a big picture view. If you notice, we're underneath this resistance level. This was back in the 80s and 90s. We did a big first surge higher underneath it. We pulled back, and then we launched past it in a wave 1, wave 2, wave 3, wave 4, wave 5 is the peak. We went into a large consolidation zone, and now we've broken that consolidation. We've broken the trend line to the upside, and now we're doing a retest move. What do I do on the retests? I buy them. I buy and I buy. Now, could this dip a little bit below it and go to 40 or go to 50, $60, $50 on a false breakout? Yes, it could. I'm not saying it can't. But what I do see is a big bull market that's coming. And we've got the commodity stock ratio that was cheap in 98, which is about this area right here. And we've got another one in 2020. Very cheap, and we're starting to turn on higher. That's what I led with. That first chart was the commodity stock ratio. That's what these circles are the bottoms of those ratios. And we've got the same conditions that this went up under. Expansionary phase of real estate, credit expansion phase, commodity bull market. Expansionary phase of real estate, credit expansion, bull market in commodities. That's what's coming. And we've got supply side problems. It's going to be a big boy, maybe. Coming on down, it says, resting on the top of the world, aka support. Watch yields. If we fall in yields, game on. TYX TNX ratio increases. Yield curve uninverts. So what we're doing is we're sitting on top of this chart for gold. If those curves start to come down, they start to come down a little bit. This could be a shoulder, head, shoulder with the coming. If we come back down to wherever it wants to come back down, it's going to be fuel for gold to go higher. And this is that ratio that I talk about, the TYX TNX. When this starts to go on up, the curve on inverts. When this goes higher, it's going to be jet fuel for gold, silver, and platinum. And that I think could also, we could be in the stage, which is wave 3, where everything goes up together. Even the stock market could go up with it. It's possible if they all go up together. And then towards the end, people are going to rotate money into commodities when the stock market rolls back over. At least that's what it's done historically. Coming on down, we've got comparative inventory analysis using EIA data up to 6/14/2023. WTI is fairly valued at 70 given the current total commercial petroleum stocks. That's where we're at. We're looking for a drawdown in inventories. That's what we're looking for. And the SPR is not considered inventory. This is commercial total inventory stocks. Or we talked about European gas coming on up and electricity prices. That was that TTF Dutch. That's happening again there. We've got the ECB raises all rates by 25 basis points as expected. Depot rate 3.5, highest since 2001. They're raising rates over in Europe. Remember what I talked about the dollar. The DXY is sensitive to monetary tightening of other currencies. They're tightening these currencies at different rates. This is tightening at a different rate than the dollar. So the dollar we didn't tighten here, but they're tightening. Dollar goes lower. That is what we're probably going to see. Platinum again. This is on a shorter term time frame on logarithmic. We could be getting a bounce here for platinum. That's looking good. We've got CCJ and the Sprout Physical Uranium Trust. You can see that we've been moving. This is your expansion phase of real estate, this last one. This is your recovery phase as it recovered. And here's your breakout in 2020, 2021 of your first wave. And then I think we're going to see a big move to the upside potentially in uranium type companies. Since we're on this subject, here's free cash flow yields of selected Canadian gassy names at different Henry Hub assumptions. So what we can see is some companies are losing money at $2 Henry Hub. These companies here are your swing producers. These guys are going to be supercharged to the upside when the market conditions change and Henry Hub goes up $3, $4, $5. And this is your free cash flow yield percent for these companies as it goes up in price. You can see that these guys that are swing producers that are losing money here are making a lot of money over here. On a percent change difference of losing money to this, it's an infinite return. That is why high cost producers make more money, or I should say return more money to shareholders, because their earnings per share go up more drastically from a low price to a high price than they do from Vermilion already making a bunch to Vermilion making a little bit more. They're not as sensitive. PIPE, KEL, and BIR are very sensitive to the price movements, which is a supercharge to the returns potentially, if you get the commodity price correct. The direction, I should say. COMEX silver inventory down another 602,000 today, while dopes get short futures. Robust physical demand is rapidly drawing down exchange stocks, resulting in a powder keg that could erupt at any time and send silver prices up a good amount. So we continue to draw down inventory for silver. This is SPX. So SPX has had great follow through after blue breakout. As said for 5 months, this is not a chart in distress, deflation, rate hikes, recession. Second GFC threats, etc., are there, but need to stay with chart evidence. Now it has a higher high above August high. The secular bull lives. And this is for the S&P 500. And we're still moving on up in the short term. I think we're going to peak out at some point, double top, whatever it is. But we'll see. The previous uranium bull cycle saw price run from 10 to 134 a pound in less than 4 years. The physical market then was never as thin as it is now, and it's not even close. So we're at a very thin market. We didn't really have any shortages of uranium in the previous bull markets. Now we'll see where things go. It's going to get real interesting. And that's why I am a big investor. I have a okay allocation towards uranium. Now, copyrights, Stimmy, that's obviously Timmy. It says, China plans new spending drive, other stimulus to revive flagging economy. Officials consider issuing $140 billion of special bonds to help indebted local government boost spending. Other possible steps include looser restrictions on second homes and all that other stuff. They went through a housing market crash. They're going through a recovery phase, and generally their tech stocks and stocks will do incredibly well during this time frame. That is why I am ultra bullish in emerging markets, because that is the time where you have low interest rates, and that's why they're going to increase other stimulus things. They're going to drive down interest rates. They're going to print money, and it's going to go into the stock market probably. They're not going to be able to boost the real estate market because their demographic isn't there to really boost it anymore. It's really starting to contract. So I think the technology stocks could do quite well. They could do. We've got my August 3rd, 2022 roadmap playing out very well. Much bigger roadmap is unfolding. Don't follow current headlines, news narratives, follow the charts. Inflation rate, this is your US initial claims. Your claims are going to increase along with your inflation, and that is going to occur as the market shifts around. So as interest rates go up, as some of these areas from inflation are going to put pressure on companies' margins, they're going to start to do layoffs. And I do think that we are going to go from a low employment rate into a higher unemployment rate as the bull market progresses. And as we go into a hyper bubble for the real estate market, construction jobs are going to tail off too. And you're going to see a large unemployment towards the end of the bull market. But it's going to take some time. It's going to take some time for that to do all that. We're very early in this phase here. URA breaking out on the short-term time frame. This is a double bottom that's starting to break to the upside. Doesn't look too bad, but again, short-term charts. This is a 5-minute. Are not as they're not as robust as the longer term, in my opinion. Anything can impact the price movements, news, or whatever. So I don't hold them as solid, but it does look good to move on up. Europe is waltzing back into an energy crisis. Natural gas prices are there. There are up 70% in the past 5 days. There's TTF ripping it again. Homes are less affordable than any time since 1985. The U.S. has a shortage of 2.5 million homes. The only things that will make housing affordable again are building more apartments and condos, lower interest rates, and a big wage increase without inflation. I agree. Again, Logan is stating we're going to do another. It's not a 2007, 2008 threat. 2007 had 4 million active listings. We were way up here. Now we're down in no man's land. Come on down. It says we had massive credit stress buildup in 05, 06, 07, and in 08, all before the job loss recession in 2008. We do not have that massive credit stress buildup over here. This is your credit stress buildup. We even had some bankruptcies back here, but it was credit stress buildup here for foreclosures. We don't have that. It's still very low. We're very early. We still have some years ahead of us for this to basically build. It says we're already had the sales crash, and we have gotten to historically low levels with total inventory levels not getting back to 2019 levels. So that's already behind us. Existing home sales have crashed, but we don't have the inventory, which means the affordability had an impact on sales, but not an impact on price or our inventory levels. Question is, can you have a massive price crash with stable demand and low inventory? And he says it is not mathematically possible to have a major housing crash with such low inventory and stable housing demand. Lead analyst at Housing Wire. And I agree with them. You can't have it. He did a video there. It says it's crazy to think, but the active listings inventory is weeks away from printing negative year-over-year data. Part of the issue we have is new listing housing data in 21 and 22. New listing data was trending at all-time lows, even when we had 3% mortgage rates. 2023, it created a brand new all-time low data set on new listings. We continue to list fewer and fewer homes on the market. So it says key, the credit channels run inventory channels. Homeowners are doing fine. They have low total debt cost versus their total wages. Distressed selling is minimal today. With some clarity of 22, 23 data, this podcast will be educational tutorial. So that's what we have. Matamash, that's his last name. It's been a mildly positive year for housing, but the real story is still inventory. And then we go into inventory and how low it is. Unlike NAR data, which is around 1 million this year, we track the live weekly active and new listing data. We are currently at 443,000 single-family homes as of last week. That's more than last year, but last year home sales collapsed. Now it's just stabilizing, nothing more. Very low levels. So I'm going to stop it there, guys. We'll stop it there. I know we got a lot of data going on, but that's what I'm seeing in the markets right now. And that's what my opinions are. Everything's pointing commodity bull market. And the driving factors of it is the expansionary phase of real estate. And that's still holding together. If we don't have inventory of existing homes, people are going to run to new homes. New homes is where that credit expansion phase is going to come from. The credit, the money coming into the system, is what puts everything into a shortage. And that's where your commodity bull market comes from, because interest rates, it's going to be inflation, and then interest rates follow as inflation higher. And where Powell is trying to do, what he's trying to do is hold interest rates up. He's trying to stop this from happening. If he lowers interest rates for whatever reason, if it's credit problems, debt problems, interest rate problems, if he lowers that down, he's going to have to, he's going to cause a real estate boom. So he has to hold interest rates up. The problem is the debt becomes a problem. So that's what we've got. Thumb up for the content, subscribe to the channel. We'll catch you guys next time. This is Finding Value.